Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
And Jim, thanks as always for having me.
The official inflation numbers in the U.S. were released yesterday, 5.4% annually, and of course that doesn't include energy or housing. Both Canada and the U.S. agreed back in the 90s, I believe, to not include food and housing because they're too volatile. And they also don't include increases in taxes, which have gone up tremendously since the mid-90s. So, but even taking those factors out, they say it's going to cost us 5.4% more to live. How does that factor into investing in the stock market?
Well, I agree. It's costing more to live every day. The prices are, there's no doubt, the cost of living is just going up and up and up. And what we've seen in this post-COVID world is just absolutely incredible. But back to the numbers, another statistical tidbit, when the last time, we had 2 months in a row with the CPI growth rate over 5% was June 2008, and we know what pretty well followed that. And so, when you look at it from a little bit different perspective and look at it, what interest rates are telling us, if inflation is so rampant, and I like I said, I don't mean to sound like I'm talking out both sides of my mouth. I get it. I'm not denying the increased costs and everything. I mean, obviously. But what I'm saying is, I do think that it is a phenomenon. It's, I think it's, lack of better words, to use, Powell's words, it's transitory, I think. I do agree with him. Found something I can agree with the man on, which I think is a tax, an additional tax, if you will, or burden on the system and on the so-called recovery. And if this inflation were long-lasting and real, then I go back to why are rates doing what they're doing? Why are rates so low? Why are they having to do the reverse repos to put a floor under the short-term rates? And so, I'm not denying the number, but I think there's always more to the story. And I don't think that it's long-term. On the note of the repos, we've topped now. Let's say, yes, we have, unless I'm missing a number. Yes, we saw an all-time record today as we speak on the reverse repos, $1.087 trillion today, for a single day. And so the reverse repo numbers are just going parabolic. We're already at 8.7 trillion for this month. Last month was 17.8, and the numbers are just going insane. And so what I think, I'm going to cover this in great detail in the August letter, but this all started. I understand there's many moving parts here, but part of it's collateral issues. But as I look at it, engage it, what it boils down to is, and when it started was, it had to do with putting a floor under short-term rates, and because I think that's the trigger point. Is rates just drifted lower and lower and lower back in March and then again in May. And so it's worked to some degree, but I think that's beginning to well, let me say it another way. I think it's beginning to wane, but it's taking more and more and more effort to hold these short-term rates off of that floor. And that's why we're seeing the parabolic move here. And so that's something that nobody's really looking at, and it tells us that something is going on under the surface. They are fighting. Nobody wants to hear it because all the buzz is about the inflation, which I get. We see it. I mean, I go to the grocery store too. But what I'm saying is that what they're fighting is massive deflation. and that's what this is all about. That's what's trying to set up here. That's what they're trying to hold, and it's why they're trying to hold the short-term rates.
You mentioned the last time we saw inflation rates over 5%, 2008. We know what happened. We had a major recession. Does that mean a major recession is around the corner again?
I think it's trying to set up. Yes, I don't think we ever got out of the major recession. You know, to have this market where it is on the back of this COVID thing, yeah, there's been a little bit of a recovery, obviously, and that's been fueled by the stimulus packages, which, by the way, it's interesting to note from my seat that, you know, every time the market will get a little wobbly, we used that word last time, I couldn't say it then, but every time the market will get a little wobbly, then it's coincidental that that's when they roll out the stimulus package. And now, you know, just this week, we were back in a little bit of a wobbly scenario, and lo and behold, here goes the infrastructure bill. And it's all about expanding the debt and trying to keep this thing going, because it is the underlying tones of the massive deflation that they are fighting and trying to keep at bay.
Now, let's try to get our heads around what is a reverse repo and what does it do?
Jim, I don't fully understand the reverse repo. It's terribly complicated. What it boils down to is it is adding liquidity to the market, and from my seat, it is a gauge of, or let me say it another way. I'm using it as a gauge of their effectiveness at holding and stemming the turning of the tide with the entire asset bubble by trying to put a floor under the short-term rate. So as I'm looking at it, it's a tool to hold short-term rates off of that 2020 floor.
The last time I can remember really super rampant inflation was the late 70s, early 80s, when the Canadian savings bond paid 21%. And your boss, if you had a good boss, would give you a cost of living bonus every 3 months that amounted to $200 or $300.
Well, and that's kind of what I'm saying here. We see this inflationary talk. We see these inflationary numbers, but interest rates are not telling us the same thing. You just made the point for me. Interest rates being this low, it's not, they're not in agreement. And I think interest rates are telling the real tale. And so it comes down to how long can they continue the juggling act of keeping this thing up, you know, until they can't. You know, I don't, you know, we don't have that crystal ball, but until they can't. And I'm telling you, it's taking more and more and more effort. I think what it's telling us is that the liquidity crisis that is taking place under the surface that they're having to feed is growing. And like I said, as I'm looking at it, my measure or my gauge, if you will, is the effectiveness of holding that short-term rate. And it's taking infinitely more every month to hold those rates. And I think that tells us that something is not right. Something is obviously not right.
Well, we have very low rates. It's good for governments that owe a lot of money, or for somebody purchasing a home who wants a low mortgage rate. But on the other hand, it's very painful for insurance companies, pension funds, and banks that used to make money lending money.
Right, and it's not a sign of a growing economy. I mean, interest rates is it's the price of money. It's the demand for money, and we've talked about that before. So these low rates, you know, it's a sign of a tight economy. You know, one that is not expanding. It's the opposite of what people think.
Also, people use their COVID recovery money, both in Canada and the U.S., to pay off their credit cards and other debts. I don't know if people are really willing to get into that credit card trap again, because they didn't lower their interest rates.
I don't know. I don't have any data on, you know, I hadn't looked at it. I know I haven't looked at the consumer, credit card or debt levels in a while. I know where to look at the data, but just haven't.
Yeah, but we do know we have record, margin on the stock market right now, where people have borrowed a tremendous amount of money to buy stocks. What kind of position are they going to be in? So many people are saying we're in for a correction, and you're saying if the market's gone up 60, 70% since the last time, it could fall that much.
What I'm saying is, yes, and you're right about the margin debt. I had some statistics on that in the last letter as well, and yes, you're 100% right. But what I'm seeing is that this asset bubble, and I mean, how do I say it? It's a everything bubble at this point. I mean, everything from, I see it in vintage stereo equipment. I see it in collectibles of all kinds. I see it in, it's with housing. It's been, everything. It's everything. Used cars. We were talking about that before we came on the air. Everything, is in a bubble. And what I'm saying is that all these efforts to hold it, stem the tide, if you will, reinflate, on and on and on, bottom line, it's just made matters worse. And the short-term rates is telling the story, or the interest rates, period, are telling the story. There is no growth. There is no real expansion of the economy. That we're seeing the biggest disconnect in stock market history. There is no rationale behind stock prices versus what, the world has been through in the last 18 months. And so, this scheme of holding things together, yes, working now, but it's still a scheme, it's still a bubble, and the efforts that we're seeing by the Fed and so forth with these reverse repos, it's a sign. It's telling us something. If everything was fine, then why would they be doing it? They've never done this before. And so obviously, the fire truck's not outside with the hose in their hand because there's not a problem. So there is a problem, but so far they've been successful, and they keep pulling a rabbit out of the hat and a rabbit out of the hat and a rabbit out of the hat, and they've extended it beyond, my comprehension, but it doesn't change the fact that we're in the environment that we're in, and it's gonna set up and crack. I think when we get the structure, and we're seeing, and in some of the underlying indexes in sectors, I've already seen that process is underway, but we haven't seen it bleed over into the mainstream indexes and averages just yet.
Well, the last time we talked, I think we mentioned that all these indexes are only being held up by 3 or 4 major stocks. The other ones are declining.
Yeah, and that's what I was saying. For example, if you look at, and I don't remember the list by heart, but I've got a list of them on my desk. But I do know that the American Stock Exchange, for example, some of the small caps, and I remember airlines, and of course housing and home furnishings, and some of the leisure indexes, and there's some other sectors. I think even the oil, some of the oil indexes and so forth look like they've topped and rolled. And that's what I'm saying, is that we're seeing that process underway where some of this underlying stuff is trying to turn, but we also have, it's literally a battle. Think of it as a tug of war. It's a battle between the market forces and the powers that be to try to hold it with these operations. And so, while we're seeing that this stuff happening under the surface, and we're seeing their efforts of what they're doing with these reverse repos, et cetera, to try to hold it, and but it hasn't got to the tipping point where it has bled over into these mainstream indexes and averages, and until the S&P and the Dow and the NASDAQ set up and crack, then, none of that other stuff matters. It's just cover, or what I'm trying to say is those mainstream indexes and averages are cover because that's what everybody looks at for what's going on under the surface. And so from my seat, it all comes down to the structure, the cyclical structure in those indexes and averages, and then I have, I call it my checkmate chart, but basically a model looking at when these short-term rates trigger and tell us that the crisis is at hand. And when those two things happen, then I think the fireworks are gonna fly.
We'll have more with Tim Cyclesman Wood right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, when this bicycle tips over, is there any such place as a safe haven?
I think, contrary to popular belief as always, I think the dollar. Because it's an everything asset bubble, pretty much just like '08. In '08, everything went down. And even in 2020, look at it. Everything went down together. So, just why would this time be different? But just common sense looking at it, everything went up together. It's a process of everything rolling. And like I said, it just hasn't quite bitten yet. But no, I think everything goes down together, and the best place to be is going to be on the sideline, which means to be in cash, in my opinion. Sure, there's always a few pockets, but, I don't know what those might be. I think, gold has already peaked with that 9-year cycle top. We saw gold get hit pretty hard earlier this week. The gold indexes, XAU, HUI, they've been hit pretty hard. They're back on, I think, their March lows, as I remember. I say that without looking at a chart. So they've been hit pretty hard. Even the cryptocurrencies, of course, they've bounced some since their July lows, but they've been hit hard. And so I think the process has begun, and like I said, the battle is at hand, but it just hasn't bled over into the mainstream. But when it all goes, I think it all goes. And I go back to a statement I've made all along, show me one bubble that when the bubble truly unwinds, show me one bubble where it doesn't just collapse. And so, there is none. The history, there is no example of a bubble where it doesn't just completely unravel. So, my point is that's the danger that we face. That's what they've been fighting. They know this, and so that's why they've been trying to hold it at bay. But once it goes, that's what I'm expecting is a complete unraveling of all asset classes.
What happens to gold and silver?
I think they go with it. Initially, I think they go with it, just like in '08. Gold. The commodities, equities peaked first in October of '07, and I think it was in July, as I recall, that crude oil finally peaked, and then I don't remember the exact top. I'm not looking at a chart, but it's sometime in '08, I believe, that gold topped, but it all ultimately went down together. Here, I think it's a little different. I believe that gold has already peaked, and I think crude oil is in the process of peaking, so it's leading just a little bit. And then, equities or the mainstream markets are kind of the holdout. So, everything peaking in close proximity. It's not exactly the same as '08, but I think it all goes down.
I don't know if you can comment on this, Tim, but President Biden is now pleading for the oil producers to up their production to lower prices because he's getting a lot of kickback on high gasoline prices in the U.S., but he's the guy who canceled the XL pipeline from Alberta, probably the most reliable source of oil for the United States.
Yeah, that's kind of a contradiction in terms, and I don't know. Let's kick off the Keystone pipeline. I had not seen that comment, but you're right. To that point, while on the one hand would you do that, and then on the other hand cry to increase production? I don't know. I can't make heads or tails out of anything they do in Washington.
And Russia has now become the second largest foreign provider of oil for the U.S. How reliable is that?
Exactly.
So you kick Canada in the teeth and then say, oh, by the way, we still want your oil.
Right.
Tim, anything else that we should be keeping an eye on right now? Any indicators that it's time to bail and head for the hills?
That's what I'm monitoring in the letter, and so I urge people, get the research. It's there. I know this is a grueling process. I know it's held on forever, but it doesn't change. Like I said, the environment we're in, and we're going to know. We saw it in 2020. We saw it in, at the previous tops. I know what we're looking for, and then I have the model with the interest rates. I know what I'm looking for there, some leading indicators, and then structure. And when all these things fall into place, it's going to be pucker time because, can the market even take a 10 or 20% decline? To give you an example, there are cycles. There are cycles that average about a year in duration, and I have the data going all the way back to the beginning of the Dow Jones Industrial Average in 1896, and I want to say that the average decline, ebb and flow, if you just take them all, add them up, and divide by however many cycles there were, the average correction for that annual cycle is like 18%. And we're so far away from that norm. I mean, that's how extreme this advance is. This market, if it tries to just make a couple of day correction, we have Powell coming out and jawboning and talking to keep it up. We have whoever's president coming out and talking. When it was Trump, he would come out, oh, we got a China deal. Oh, how great this number is or that number is. And so every time the market will even hiccup here, they're trying to hold it. And so what that tells me from my seat is that they know. That's evidence that they know how fragile the environment is. And I don't think this market can take an average 18 or 10% or 18% decline. And so I think from my seat, once it sets up and the natural forces do exert that downward cycle on the market, the risk is that it just goes. And so, just like an avalanche, that it just goes. So that is the risk with this extremity. Anytime you're at such an extreme, the problem with the average person is they don't see the extreme. They think this is a normal world, and it's not.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.